So welcome to another exclusive Open Innovator session. And today we are diving into a topic, that separates I would say, the tourists from the true visionaries, right? And the topic that we are discussing today is myths versus reality in long gestation investments. So, in a world obsessed, yes, obsessed with quarterly returns and overnight exits, we are going to talk about something far, far, far more difficult and arguably far more important. The long game, as we say it. Yes, you heard it right, the long game. And we are diving into the myths versus the reality of long gestation investments today. And you know these are the bets that don't pay off in 18 months or even in 36 months. These are the breakthroughs in deep tech, energy, life sciences, space tech that requires years of patience, massive capital, and the nerves of steel. Yes, but the myth is that these are just high risk gambles. But the reality, if you ask me, these are the foundations of the next century. And today at Open Innovator, we bring together the global thought leaders who have the vision to to see past the valley of death, to peak on the other side, and to help us separate the myths from the hard truths of long capital. We are joined by a panel of top tier investors who specialize in the impossible. And now, before we bring in our navigators that you see on the screen already, let's set the stage. There are, I was going through long researchful articles about this long term investment, and there are three myths that usually kill long gestation projects before they even start. The first one being the myth of liquidity, that your capital is trapped forever with no way out, right? And the second one that I've noted it down is a myth of binary risk, that it's either a total moonshot or a total zero with nothing in between. And the third one, the myth of the passive investors, that you can just write a check and then wait for 10 years, 10 good years, right? And today we are going to dismantle those. We are going to talk about how to structure these deals, how to manage the fatigue of a long cycle, and how to identify the moment when the long term bet becomes a near term certainty. And to navigate this valley of death, we have four world class experts with us today, right? So we have George Jones, managing director at Woodside Capital Partners and an M&A veteran in semiconductors and deep tech. Welcome, George. Lovely to have you today.
Thank you. Lovely to be here.
We also have Kesia Theobald Von Kant, the venture capital partner at BDev Ventures, specializing in the transition from seed to scale. Welcome, Kesia, to Open Innovator.
Thank you. Excited to be here. And I have to say, I don't think anyone has described my job as amazingly as you have. I feel like a superhero after that.
So I'm sure it was going to be an interesting discussion with you all. And next up, we have Matteo Oljani, associate partner at Your Group and fractional CFO at Rossitia Omics, a master of financial strategy for high growth ventures. Welcome, Matt.
Yeah, thank you for the invitation and nice to be here with you all and also with Jones and Kesha.
And thank you, Matt. And we'll shortly be joined by Deborah, who's the CEO at Onit Centers, a global business strategist who has scaled startups across different continents. So she'll be joining us shortly in between the discussion. So yes, ladies and gentlemen, they are our navigators today. And without further ado, let's get into the deep end, right? So now, as we open this session, I want to talk about the gut. In fact, the gut check. Long gestation innovation demands patience, but we know patience alone doesn't pay the bills, right? Now, George, let's start with you. You have seen decades of cycles, right? Now, I want to understand from you, George, when you are looking at a 10-year horizon, are you actually underwriting the tech? Are you actually underwriting the technology, or are you ultimately just underwriting your own conviction that the world will eventually catch up with this exciting team?
Well, the gestation period in my world, which the practice that I lead at Woodside Capital includes semiconductors, IoT, and photonics. Those are typically longer term, longer range investments. So that was one of the reasons I was interested in participating today. We did a little bit of research on this in preparation, and we looked at a whole waterfront of both IoT and semiconductor startups to liquidity. And we found that the median life cycle in semiconductors today, from start to liquidity or start to exit, about 9 years. IoT even longer, more like 11. And I'll fill in some blanks on the relative valuations depending on the timescales. And there's also, I think there's some commentary that I'd love to share at the right time on what the nature of the deals are as you go along, that time scale. I've got active clients that are at the 9 and 10 year stage right now that are in the space. And how do you present and how do you position all that stuff it's a fascinating space right now. The market dynamics are huge.
Perfect. In fact, underwriting the future state of the world, I believe it's a bold bet. But Kesha, you are often looking at that bridge where innovation has to start looking like a business, right? So, Kesha, when my question to you is, when you're looking at the team before the technology is even fully baked, right? So when you back a 7-year play, are you underwriting the founder's obsession, or are you underwriting your own conviction that you can pivot this team 3 times before they hit the right vein of gold?
That's an interesting question. I think, just to take it back a little bit to your original one, so does patience, is patience alone, or what actually earns conviction? I don't think it's patience, right? I think it's inevitability. So I'm going to take a very commercial lens to a long-term or a long horizon company. I'm looking for signals that the company is becoming what I'm going to call structurally necessary. I think there are a few places where that tends to show up. So customers, right? Like, are customers leaning in? Are they feeling this really acutely? We often hear this analogy of, like, we don't want a vitamin, we want a painkiller. Is it a founder? To your point, it's the team, right? Is it a founder who understands the commercialization path, not just the technical roadmap? You can build really cool stuff, but unless you know who you're building it for and why you're building it, it's unlikely to sell. So important part of our business, right? And then I think early proof that someone will pay, even if that's a tiny bit of revenue and LOI, some proof or some evidence that you're talking to customers and that they're actually willing to pay for this, that there's some budget there. I can tolerate technology risk a lot more than I can commercial ambiguity. So if I can see like a credible path to revenue, that's going to build conviction a lot faster than getting excited about a technology.
Perfect. There you have it. You need to identify the signal at the beginning. So it's about the early evidence of durability. But Matteo, from your seat as a CFO, you have to be the one to turn that conviction into cold, hard financial strategy. So, Matteo, when a founder is pitching a long-term play to you, how do you distinguish between legitimate strategic patience and a team that is just hoping for a miracle to solve a moving project?
So I would say that it's a mix of what also Keisha and George has already said, and a mix of personal vision and the future. So I would say the first step, as Keisha was saying, is some small signal on the component of potential revenue could be a letter of intent in many cases. In the farm or biotech, it takes more long time, some partnership at the beginning, and then that can transform in some letter of intent. And together with that, then you can stress test technology, you can assess team, and you have to have a strong go-to-market plan, because the right timing is everything. You cannot be too early or too late. Well, in the farm biotech, maybe better too early than too late in that case. But the point is that then you need to translate all these things in a solid financial architecture. It means you need to know, when you're speaking to an investor, what's your customer cost of acquisition. You need to know how much is the long-term value of the client. You need to know all this kind of financial and marketing together. Somehow you need to transform also in equity value and to transform in a solid financial plan with solid assumption.
All right, interesting take. So Matthew, I've made my notes. It's better to, too early than too late, right? And so that was an interesting take. And with this, that was quick. That was quick. And with this, we have come to an end of round one, right? Now it's time to get a little tactical, and I want to look at the specific folks into the road for these companies. We have talked about conviction, right? Now let's talk about the cold reality of the long game. I'll start with Matthew. You know, Matthew, you have advice across banking, across energy and industrials, right? So from your perspective as a CEO, when does, strategic patience actually creates value, and when does it quietly becomes an excuse for weak financial strategy?
I mean, of course, you need to be patient in that case, but you need to define the long-term view, the long-term milestone point, and the short-term milestone point, and you need to convince or negotiate with investor a good milestone, both for you, for developing technology, and both for investor. And also, you need to define with them what could be the exit strategy for them if they decide to change them. And also, you need to define which kind of investor you want, even before you define which kind of typology of instrument, between safe, equity, or whatever. You need to define if you want to go in a corporate venture capital, if you want to go in a venture capital generalist, in a family office, in a specific venture capital that has some opening door in the fields that you want to get. You need to define all the strategy and understand when and how define your capital structure and your future cap table.
Mm-hmm. Interesting. So I believe one thing is clear, that it's about measurable progress, not just waiting for a miracle, right? But Matthew's financial strategy only works if the end game, which is the exit, is built into the DNA, right? George, you see that final stage more than anyone. So in fact, George, you have led M&A transactions across semiconductors and deep hardwares for decades, right? And when you look at long gestation companies, what what early decision determine whether they become acquisition ready asset, or just stranded science projects?
It's Keisha's notion of market traction is the short answer to that. uh, and I guess I want to challenge the notion of long gestation being bad.
Mm-hmm.
I would argue that a company that's been at it and still doing okay at an 8 or 9 year mark is close, should have a much better understanding of their markets. The markets themselves have hopefully matured in the time they've been operating. And it gives you, I mean, I would almost call it the depth of their moat gets better. And so that company can have a much better defensive strategy. Chances are their IP is much more mature, which could provide defensive strategies for an acquirer. And so instead of looking at it as kind of a closed door within a finite duration fund, I would say there's a maturity premium that you could consider. instead of a long gestation, is my IR is going to get worse because I'm going to wait another year. That attitude I hear all the time. But in reality, a lot of these markets and the real value of some of these companies takes longer than you want, and I've got a client, for example, that's in the operates in the world of AR glasses and the some display technologies that go with that. The changes in the fundamental technology that's being employed there is fundamental to their success. They've made a future choice that I'm convinced is the right one, but the market's not ready for it yet. So they got to figure out a way to survive. And this is measured in years, not quarters.
Well,
So
all right.
so this is sort of contrarian insight. I mean, I think the fixed duration of most VC funds is problematic. If you've got a 10-year limit on your fund and a 9 to 11-year gestation, you do the math.
Can I jump on what George is saying here really quick? I agree. I think the 10-year fund is largely I don't know that it serves many investors at this point. But the reality is that on average, at least in 2025, the average fund, even though it's set up for 10 years because of extensions, is 17 years. So even though it's set up in this kind of idealistic 10-year model, very few funds are actually able to execute on that because of so many factors. Investments just take longer.
Yep. And the process of closing the fund is not for the weak at heart.
Perfect. So we have got a variety of takes on that particular part. So Kesha, let me ask you, across the companies you have seen from late seed to series B, what's the clearest pattern you have observed in ventures that successfully transition from promising innovation to, scalable business?
What takes you from promising innovation to scalable business? I think the reality here is I'm going to focus again on kind of that economic validation. So, at the end of the day, that shift happens when companies move from product validation, so kind of this emphasis on technology and just the technology work, to economic. And I think the winners, what I want to see companies do is start focusing on their ICP, narrowing that down. If you're still selling to everyone, you're selling to no one. I want them to understand pricing and align pricing to value, right? So really understand, what is the ultimate value of this for my customer? How does pricing align with that? I want them to start building systems. I want to see a playbook for sales. I want to see a playbook for customer success, even if it's not fully baked. In my experience, the companies that really stall and focus on polishing that product before going to market, before getting it in the hands of customers and then reiterating, are the ones that struggle to break through, right? Innovation, I think I've heard this said before. This is not an original thought. Innovation gets you to seed, discipline gets you to series B. And I think that's very accurate.
There you have it. The word has been said out loud. Innovation get you to seed, and innovation get you to series B. That's a great take, Kesha. Also, I just want to bring in. All right, so we are still waiting for Deborah, but while she joins, I would like to shift gears now. This is the time value torture test, as I call it. I repeat. Now we have moved to a new segment. It's called the time value torture test, right? I am giving each of our navigators that you see on the screen 60 seconds of rapid fire pressure, right? And one word answer or short phrases only that I would expect. And remember, you can't say depends, and you can't say maybe, and definitely no spreadsheets. All right, Kesha. So so first on the hot seat, I would like to invite Kesha. So first on the hot seat, you are there.
Okay.
So, all right. So 60 second it is, right? You are up. So you bridge the gap from seed to scale, right? So a perfect product that's late, or a good enough product that's early?
Good enough product that hits the market at the right time is best.
Good enough
The
for us. All
best
right. True.
technology often doesn't win. Sorry.
Perfect. Perfect. True or false? Series B is the new valley of death.
False.
False. All right. So
It
top.
depends.
All right, that's a subjective thing. All right. So top trait for long gestation founder: intelligence or obsession?
Obsession without intelligence is frightening. So, intelligence?
Intelligence it is. All right. So now what's more dangerous? Too much capital too early or too little capital too late?
I went to law school once upon a time, and it depends is my favorite saying. Uh, I'm going to say too much capital too late. If you miss the window.
Perfect. Last one. So venture capital in 2026 still adventure capital? Yes or no?
Sorry, say that again.
So VC in 2026, venture capital in 2026, is it still adventure capital? Yes or no?
I think that we sometimes, but we're definitely seeing more. The venture capital market is becoming more concentrated around a few deals, and
Mhm.
we're seeing less wild bets, which is too bad, because those are the most fun.
All right, all right. We are on time, almost on time. Fast and focus, I would say. Matthew, I'll bring you in next. As of CFO, you have to be the voice of reason, right? So let's see your gut reaction. 60 seconds, Matthew. High burn with high growth or low burn with slow growth?
Oh, that's the favorite answer is the same occasion. It depends because if you have high burn with high growth, you need to have the back behind a VC and have already done your money. And it mean is not be too early because of the reason Kesha was saying.
Right.
And the second part, if you want to go to low burn and low grow, that's something more safe on the point of view of a startupper, but still you need to create a grow. And if you're able to create a product on that, probably you are not in the market of high investment, deep tech or pharma tech or something like that. We are more in a SaaS or something similar to a SaaS as
Right.
market. That's completely different market than
So
long and patient. Is quick and soon.
perfect. True or false? True or false, Matthew? Most strategic patience is actually just a CEO afraid to pivot.
Sorry, I've not heard you.
The strategic patience is actually just a CEO who's afraid to pivot. All
I
right,
would
we'll move.
say
Mhm.
I would say no. Still depends on the market you are in.
All right. Now, next one, the biggest budget killer in deep tech. Is it R&D or is it marketing?
Deep tech is R&D usually, and then you need marketing as well. But it's R&D the first step to and IP.
All right. Last one, a founder. So what would be the CFO's biggest nightmare? A founder who won't stop hiring or a founder who won't stop tinkering?
Full stop. Sorry, the second one.
Who don't stop tinkering or let's say don't stop experimenting new things?
Okay. That would then stop experimenting new thing when we have a solid path. Because
Perfect,
in some
perfect,
case you
perfect.
need to pivot.
I would agree. So finally, George, you have seen more deals than most people have seen movies here. You are closing us out 60 seconds. So George, acquisition in 4 years for 100 million or IPO in 10 years for 1 billion.
Oh, I like the 10 years and 1 billion. And I say that because of the space I operate in. It's very unusual to get to a 4-year, $100 million revenue point in semiconductors, IoT, and even photonics. There are a few outliers, and those are driving huge deals. So don't get me wrong. But I feel like the bigger valuation is the better path.
Perfect. Now, next one, the number one deal killer in M&A. Is it the dirty cap table or egos in the boardroom?
Egos in the boardroom.
Perfect, perfect.
Not even a
All,
contest.
not even a
You can
contest,
fix,
not
you
even
can
a
fix a
contest.
cap table.
All right. Next one, hardware is easy, hard, or the new software?
Hardware, without hardware, software does not exist.
Mm-hmm.
You got to run software on something.
Right.
And so,
True.
and I will add, there's some really interesting new business models related to reconfigurable hardware that are going on. And so they become a proxy to, not a proxy, they become a way to implement the software at much higher levels of performance.
All right. So now, George, this is my personal favorite, and especially for you. True or false? You can tell a winner within the first 5 minutes of a pitch.
I get a pretty good idea.
I'm sure. All right.
I
Next
trust my,
one, last one.
well, I mean, I trust my gut, but
Mm-hmm.
yeah, I'm wrong about 30% of the time.
30%, but 70% you're right. All right. So, all right. Now the
It,
last one, bet the jockey. I mean, you bet the jockey, which is a founder, or you bet the horse, which is a technology.
that's a great question. You
Time's
can
running.
replace the jockey easier than you can replace the horse. I tend to, if you got to retool a management team or fill in something, you can do that. You can put a new jockey on, but the technology is harder to modify or harder to
And
fix.
And I would say that's an equally amazing answer. Thank you, George. Thank you. And our chatbot is now filled with a lot of questions that we will
Okay.
like to take now, right? And all right, so we'll start with some of the questions that we have. All right, so we have one question for the whole panel. In a 10-year journey, a pivot is almost inevitable. So how do you distinguish between a founder who is pivoting to survive and a founder who has simply lost their way? Anyone. It's an open question. Anyone can take it up.
The ones I see that experiment intelligently are the ones that win more. And an intelligent experiment, like in a new market segment, for example, is one that you've got to carry through to completion. So the error that I see not infrequently is a partial attempt at an experiment, not seeing it all the way through, to develop, as I say, for a new market. Yeah. So could you take an actuator that's good for a mobile phone, for example, and adapt it to a medical pumping application? I've got a client that does exactly that. So what's really important in presenting to potential buyers and investors is, can the company cover all those market segments? Have they done any of them well? And you've got to me, this failure to complete a thoughtful experiment and a way into a new, particularly a new market or a new derivative technology is a big deal.
I
All
agree.
right.
I think
Keshav?
it's yeah, I think it's not whether someone pivots. Pivots are
Yeah.
I would be unusual to have a 10-year company and not have any pivots. But it's the how and the why. And if something's changing in the market and you're reacting to that, if you're learning things about your customers and you're reacting to that, I think, and you're taking those little experiments in that direction, there's still core insight there, then I think that makes a lot of sense. Typically, when we see a good pivot, there's still strong continuity in that shift. Like there's a clear narrative here. They're still trying to solve this problem. Or maybe they've dug a little deeper and they realize, oh, this is the problem we were solving is actually not the true problem. That's a symptom. And so we're going a level deeper or something to that effect. But I think pivots are inevitable.
Pivots are inevitable. All right. We have another question. We have Adriana from TEDx. So she has a question for George, and others can answer as well. George, in deep tech sectors like semiconductors, the state of the art evolves roughly every 24 months. How do you ensure that a 10-year project doesn't become technically obsolete before it even reaches its M&A window?
Oh, so on the process side, if you move from analog to digital, you can scale to more advanced processes. Many companies make the mistake of staying in analog way too long. So on a technical level, that's one part of the answer. The other is, I guess, just adaptability. You don't, great semiconductor exits don't happen with one product only. It takes multiple versions and oftentimes multiple generations to get there. And so I argue that as long if the architecture is well devised, then you can solve that problem. If it's not well devised, and this example of putting more into digital and less into analog is just an example.
Perfect. Anyone else would like to take it up, Matt? Or we'll take one more questions. Should investor treat deep tech more like infrastructure projects than startups? Should investor treat deep tech more like infrastructure projects than startups? Well, that's an interesting question. Anyone?
George, do you have any experience in funding infrastructure projects? Because
Yes.
I don't. So
Oh yeah, I ran an energy storage systems company for about 5 years, and that was by definition infrastructure. It's a completely different animal.
That would be my take. Yeah.
Oh yeah, yeah. So I don't think it's a good proxy for a component IoT or that sort of play.
Because infrastructure,
all right.
It's like
usually the capital requirements are quite different. The
Yeah.
the market pace is different. How do you deal with how do you distribute this stuff is usually a big problem for a small company. So different problem in my opinion.
I agree. All right. So we'll take one more question. Every investor, and this is open for all, every investor has a red line. Okay. What is one thing beyond a lack of cash that makes you decide long gestation project is no longer worth the wait?
No longer worth the wait, as in we kind of write off the investment, or not worth it and we don't invest?
Mm-hmm. So I'm not sure. I believe you can answer based on your understanding. Mm-hmm.
I think there are a lot of reasons why you would take a step back from an investment, right? So there's a lot of reasons why, even though you may be looking at a company and think, really like the technology, I agree with maybe your vision of the future and how this market is going to develop. And maybe I even believe that there is some inevitability in what you're pitching me. But I may not have conviction that you're the right person to do it. I may see that we talked earlier about obsession. Obsession's amazing. Like, you want people to be a little bit obsessed, right? That's the fuel that gets you through those, especially
Right.
early on. Being a founder sucks. It's really hard. And there's a lot of, there's a lot of ups and downs, right? So you need that, you need that fuel. But you also need to be someone who's who's still attached to reality. You need to be someone who understands, I'm obsessed, but I'm obsessed with the outcome, not necessarily with the journey to get there. We're talking about pivoting. Are you someone who's making good decisions about the future of the company? Sometimes it can also be, and I think this is one of the most frustrating things for founders, but important, since there's some founders on the call, sometimes it's just not a fit with my thesis. I may think everything you're doing is really cool and really interesting. I don't invest in robotics. I get pitched on really cool robotics companies, but I'll never say yes because it's just not a part of my thesis. It's not what we've raised money around. That's not the commitment we've made to our LPs. And so it's just not a good fit with our fund. And that can be true oftentimes. So there's a plethora of other reasons.
And
George?
to all our attendees and listeners, you also got a big life lesson out there. If you want to be obsessed with the outcome. Well, that's a very beautiful take, right? And I'll take this one more question. Yes, please, Matt, please.
If I can jump in with what Kesha was saying, to me, more obsessed on the outcome, obsessed with the mission. I mean, could be something like for Rosetta, that where the founder is obsessed with the mission to find a better cure against cancer. So he's obsessed about that. Then the journey could be any pivot in the middle, in the between, or whatever. We don't even know now. Or everything else, or if you are doing something different in any other space, because said how you want to help people doing something or help company doing something, then how you got there. There is we many way to get there, and you don't know.
All right, good one. And I'll just close this audience round with one more question. Okay, so I have a question for me. You have done a great job handling these geniuses today. All right, thank you. So does this mean
Careful
we
who
should?
you call genius.
So to all our panelists, so does this mean we should expect the Open Innovator Venture Fund led by you to launch next week? Okay, that's a big ask. People ask me that a lot, but here's the truth. Right now, my fund is intellectual capital, I would say, and at Open Innovator, we aren't just trying to pick up a single winner. We are building a map. And if I launch a fund tomorrow, I would have to pick a side, right? I would have to worry about a specific portfolio. Instead, I get to sit in the control room, as you can see. And beside, you know, if I were the one writing checks, George and Kesha would stop telling me their secrets, and I would have to start answering that annoying question instead of asking them. So I'm pretty comfortable here. But in all seriousness, whether you are writing the checks or building the breakthrough, the logic we have uncovered today remains the same. The roadmap to 2026 is about discipline. It's about understanding the most significant wealth isn't created in the noise of the next 18 months. In fact, like Keshi and George and Matt said, it's built in the silence of the next 10 years, right? And all right, having said that, we will now move and jump into a last round of the discussion, and wherein we'll take one question with all our speakers, right? And I'm just checking and seeing if Deborah has joined. She's not here, right? But anyway, so we'll start with Matt. Matt, from a, and this is a final question for all our navigators, if a founder building a 7 to 10 year deep tech economy is watching this recording right now, I want to give them one North Star to follow from the very start. So, Matt, from a CFO perspective, what's one day one financial habit that separate the winners from the bankrupt science experiments?
Yeah, I will say first point, decide where you want to go in your mission, your vision, and transform that in also in a financial architecture and structure. Mean you need to know immediately how much runway you have, how much time you can survive without any income. You need to know how much you need to spend and whatever. So you need to have construct a convincing investor stories. That means after you have financial architecture, a convincing investor story, thinking with them. I mean, what's the benefit for them to invest in you? Not for you, but for them.
Not for you, but for them. All right. Short and crisp. Great. So, George, the financial discipline is the fuel for the long haul. And George, now let's look at the end of the other tunnel, right? And from an M&A perspective, what is the one thing they must get right on day one to be sellable in year 10?
Well, the usual mantra for any startup that I like to throw out is go in this order: sell, design, build. If you've got a customer on the other end, all kinds of problems go away. So you've got to go in that order. You've got to listen to what the customer is saying. And if it's the wrong customer, go find another one.
Sell, design, and build. Perfect, perfect. We have made our notes. So Kesha, from a VC perspective, what's the thing on day one trade that ensures a founder can keep raising capital through a decade-long gestation cycle?
So I'm going to piggyback on what George is saying, and I think it's designing for commercial inevitability. right? You're looking at like you're anchoring on that real pain point. You're proving your roadmap may be really long, but you're proving really early that someone's going to pay for this. And not just someone, but someone with a budget. So I think, those are the things. Technology will evolve, you pivot, your features change. But if you're a real company and you're really anchored on solving a pain point and you have real customers, you'll be okay.
You'll be okay. All right. All right. And that's again a great end to round 4. But before that, we'll take one more question, right? And all right. This is again a question from one of our audiences. What lessons from the past economic cycles can guide the allocation of capital towards deep tech or startups today? So it's open for all, anyone who wishes to answer. What lessons from past economic cycles can guide the allocation of capital towards startups today?
There's a lot of lessons. Oh, Matteo, go ahead.
No, go, Kesha. I will take it later.
Okay. There's a lot of lessons that we can learn from the past, even very recent past. I think talking to founders, it's very important that founders understand the business model of a VC. If you are fundraising, it is critical that you understand my business model and how I make money and what I'm looking for. 2020, we saw capital was very cheap, right? So this is a very recent history lesson. Capital was really cheap, interest rates were really low. So we saw a ton of money flood into the private markets. A lot of people were raising venture capital funds. The number of funds in the US almost doubled. Now, most of those were very small, micro funds, but nonetheless, a ton of new capital, a ton of new people investing, and that drove up valuations. And founders were raising these crazy big rounds. I'm sure there's a lot of people here who remember. It was like you could raise a lot of money on a slide deck, and maybe you shouldn't have, because what almost inevitably happened, we've seen this cycle before, is that money got more expensive, right? That cheap capital kind of went away. Interest rates go up. There's now all this capital is locked in. We saw that valuations on average come down, which left a lot of founders raising down rounds, even though maybe they had a really interesting, viable company, they couldn't raise again, or if they did, they're raising a down round, which is a very negative signal. And it created a lack of liquidity, which created a lack of new venture funds, which created even less dry powder in the market. And I think this cycle was really important because this is very recent, but there's so many great lessons that come out of that, especially for founders. Raise what you need to grow. If someone's offering you more capital than that, do you really need it? Do you have a use for it? Is that realistic for you? What does it mean the next time you fundraise? More money isn't always better.
Matthew.
Yes, I would add something that you need also to know the part of, as also Kesha was mentioning, the part of what's your revenue compared to your cost in terms, especially of cash flow. Many times undervaluated. What is cash flow? That is not your EBITDA. It's two different story. Even it's close, but not always the same. There are some technicalities that give away, but the point is to pay attention if you have too much cash outflow compared to the cash inflow. You need to be aware of what your cash in your bank account, let's say, to simplify.
Right. So that's again interesting take. So right, I think we have covered it all, right? And I think we have covered the tech part, we have covered the money part, the maps. Now to close us out, I want one final truth from each of you, and this will be a closing question. So let's say when it's the 10th year or year 10 and the world is finally using this technology, what is one thing that will, make you look back and say, hey, the struggle was really worth it? We'll start with George.
Well, if you can get to an exit point at 10 years with all the work you've done, that's a good proof point. I also think if you could look back at your early business plan and see how you've evolved from there, and understand, yeah, have you made the right pivots? Have you capitalized in the right way at the right time? I hearken back to Keisha's last comment. I think the conditions of today are a lot like the conditions of 1999 and 2000, raising too much money at too high valuation in 2020. Yeah. So there's a lot of that going around, especially AI stuff. And to the detriment of quality companies that should be able to raise money and are having difficulty breaking through. So didn't mean to, I didn't quite answer the same question, but hopefully that helps.
All right, answered it well. Yes, Kesha.
Exits, or whatever your goals are as a founder, right? I think my advice to anyone thinking about starting a company is understand how you're going to get out of it. Most people who make money with startups don't do that through an IPO. Lofty goal could be really fun if that's what you're aiming for. But most don't get there. Most get acquired, right? So understand when you get in, understand how you want to get out, and understand what your goals are. And that can be different for every founder. You may sell at Series A or even, pre-Series A through some type of an acqui-hire. And that can be a really great outcome, especially if you've not raised a ton of capital yet. So I say it's individual. And also, hopefully, you're coming out of that 10 years and you're not feeling like you sacrificed everything and you're miserable. And hopefully, you've been able to keep some of your relationships and your integrity, and you feel good.
Well, that's a great point of view, right? Matthew?
Yeah, I will say, of course, you get an exit in 10 years is good, but also, as Kesha was saying, it depends what's your objective, IPOs and Series A, but you can consider also to sell some small part in the series before. So you can decide to start to selling some part of your quote even in series, in pre-seed or seed or whatever, when you think that you need to sell some small part, not too much, otherwise you not lose the control, but you can start to sell before. That's where you need the CFO to understand where it's convenient for you to sell or not. And also the component at the end, when you decide to sell the full company or do the IPO, that depends on your objective, that's fine. If after reaching this point, how is the world after you reach this point with your technology or whatever? The world is better as people, as planet, or whatever is your strategy at the beginning. Have you done something good for all of us somehow?
There's a lofty thought. That's great. I like
That's a
that.
great way to end the discussion. Well, that's a great thought to end the discussion. And I'll say this, session today has been a necessary reminder that the greatest returns aren't found in the noise of the present, but in the silence of long-term discipline. And what an exciting discussion we had today. And I was just making notes today. We have dismantled the myths. We have seen from Matthew, the reality of financial patience. From George, wow, the importance of being acquisition ready. And from Kesha, the pattern of scalability, right? And fantastic, amazing discussion. And at Open Innovator, we believe the most significant wealth isn't created in the noise of the next 18 months. It's built in the silence of the next 10 years, like I said. And in a market, obsessed with the immediate, and the greatest competitive advantage you can have is a longer horizon, right? And to all our navigators today, Matthew, George, Kesha, thank you for your candor. Your insights are the signal we needed, right? And I'm sure all our attendees are making notes and have made notes, and we'll be releasing this video and along with the podcast shortly. And to all those watching this recording, the roadmap to 2026 is in your hands. Choose your horizons wisely. Stay sharp, stay patient, and we'll meet again for the next session. The session is concluded. Thank you, everyone. Thank you once again.
Thank you, guys.
Thank you. Been a pleasure.
Happy Monday.
Thank you. It was a pleasure.